This episode of Bulletproof Cash Flow is brought to you by Realty Dynamics. Learn how people like you can build substantial passive income while creating wealth for the long term through real estate investing. Visit rdyne.com. That's RDYNE.com.
Again, it goes down to what kind of questions can you ask a property manager and what are the responses? Do those responses sound good to you? I asked them about what's their process for evictions. I asked them for the process of finding a tenant. I asked them about where they can and can't do property management services for. Some property managers will only do single family properties. Some of them are okay with doing multifamily. Some of them will do management in some neighborhoods and some won't. So I guess from there, you can kind of tell who you do want to work with and who you don't want to work with.
Working because you want to, not because you have to, is financial freedom. And we want to help you create that. Welcome to the Bulletproof Cash Flow Show. We're going to teach you how to achieve lifetime financial freedom through real estate investment. Your host is a multifamily syndicator and property developer. He's done deals reaching into the hundreds of millions of dollars. You'll hear from experts in all aspects of real estate investment, finance, development, and management. Everything you need is right here. This is the Bulletproof Cash Flow Show. And this is your host, Augustino Pintus.
Hey everyone, it's Augustino. If you don't challenge yourself and challenge your comfort zone and try new things, you're going to have a hard time building success. Now, the same thing goes for investors. Getting out of your zip code is one thing to consider to find potential deals. Now, of course, it takes a great deal of time to build the relationships, but in the long run, it is totally worth it. The key is to leverage the right tools and financing options to build that cash flow. Now, today's guest knows all about this. He has managed to do this exact same thing by looking outside his home state of Texas and acquiring properties in more reasonably priced states like Florida and Georgia. Now, before he could do that, he had to make a decision to quit his job as an engineer and learn the real estate game. It took some time, but he started investing. Now, today, he invests in single-family deals out of state and also originates hard money loans. He is the host of the We Love Real Estate Investing show, where he interviews pros to understand the best practices that can help investors like you succeed. Now, with all that, I'd like to welcome Sean Pan to the show. Sean, buddy, thanks for coming on, man.
Hey, Agostino. Thank you so much for having me on your show.
Yeah, I'm excited. I'm excited that you're on and happy you're here. Now, guys, like what Sean has to say, you can reach him via his contact page at everythingrei.com, and that'll lead you to another website, of course. But definitely check out his podcast as well, We Love Real Estate. Now, Sean, go ahead and tell listeners a little bit about your journey and how you got started.
Yeah, so my journey started almost 10 years ago. I was studying school at UCLA, trying to get my degree in electrical engineering and later my master's degree in electrical engineering. As you can tell, before all of this entrepreneurial stuff, I was very much in line with the traditional school of thought, where you go to school, get good grades, get a secure job, and then work there till you retire at age 65. But the problem happened when I was just 21 years old, and I was working at my first internship at a large defense contracting company. Now, this is a great company, one of the top 500 companies in the world. And yet my coworkers, who are my dad's age, were very unhappy with where they were in life and very unhappy with where they were financially. They wished they took more chances early on. And so that led me to believe that maybe working at this engineering firm isn't the best course of where I should be doing. So I started pouring into different books, podcasts, trying to learn more about personal finance. And that led me towards real estate and understanding how to analyze deals, understanding why real estate is a better business compared to something like selling products on Amazon. So long story short, a few years down the line, I realized I cannot be here for the rest of my life. I need to try something else. And that's how I got into real estate investing.
Nice. Good. I mean, it's funny. So many people have the same story. I did. I went to engineering school, only I ended up doing, I went in there too long. I stayed in there well into my 40s before getting canned. And then the same thing happened to me. So it's kind of
But see, that was a scary thing too.
Yeah.
I had a coworker who was close to retirement age, maybe 2 years before they would get their benefits. And same thing, they got laid off. Now, luckily, there was another department that would take them, but in Alabama. So he had to move from his house in California, leave his family for 2 years so he can still get his retirement benefits. And so he trusted the system. He thought, if I just work here, be a good employee, then I could retire at age 55 or something. But before that happened, he got let go.
Yeah,
So
and I think
there's no safety there.
Yeah, it's an antiquated system, right? I think back in the 50s and 60s, people, maybe more the 40s and 50s, maybe not so much the 60s, thinking about at that point is wearing out. But that whole concept of staying at a job and retiring with the gold watch and all that stuff, those days are long gone. And, I was told, entrepreneurship is far more risky than working at a company, which is totally not the case. I'm convinced of that. Very much so. Yeah. Very much so. So I know that you were recently in California when you started investing, and now you're in Dallas. It sounds like you just recently moved there, right?
That's right. Moved here about 2 months ago or so.
Yeah, nice, good. So I'm just curious, why'd you make the move? Besides the obvious, but I got to ask anyway.
Yeah, there's a lot of reasons. So the first thing is, my wife and I recently got married, and we were living in California our whole lives. For the most part, in Northern California. I went to UCLA, so I was in Southern California for that part. But again, we were always in California, so we never really lived outside of this area. So one, it was an opportunity to live somewhere differently, somewhere that's more of a city environment like Dallas is compared to where we were in the suburbs in the Bay Area. Second thing, probably the obvious one, is you get paid more because there is no personal state income taxes in Texas, especially compared to California where you get charged like 10% of that. Third thing is there is more opportunity here in Dallas, especially compared to the Bay Area, where my friends are paying around $20,000 in marketing costs to get one solid deal. Here in Dallas, you can find, properties on the street with signs that say "for sale by owner." What else? Also because we still have our full-time jobs from the Bay Area, but we're living in Texas. Cost of living is a lot cheaper here, so our dollar goes way further by moving as well. So those are the main factors, but that's why we moved.
That's good though, because I do know that when you started investing out of state and looking for these deals, you're doing it from California, and now it sounds like you moved to one of the markets you're targeting, right?
Exactly.
So which is an interesting strategy. So maybe for those listeners out there that want to start investing, maybe they currently live in California or even New York, what do they need to be doing to start investing in out-of-state deals? Obviously they can syndicate into deals like this, the stuff that we do in terms of like these large multifamily deals that we do, or development deals, or anything else like that. But when you're investing in single families, that's a little trickier, right? Because you don't really know the market or the area. It's like, how'd you get to learn all that? How'd you get started?
Exactly. So I would say the most important part is to determine what market you're going to invest in, because it's not enough to just find a deal on like Craigslist or some random Facebook page with one piece of property. There's a whole thing that goes on behind it. You need to create your systems first before you buy that single property. So the first one is find that target market. There's two ways to do it. Like there's the easy way and the hard way. The easy way is easier, but you're going to have a lot more competition. And the way you do that is just go online, right? Find your top 10 lists, top 10 markets to invest in. For the most part, these articles are correct. These are growing markets with a lot of potential. But again, the problem is everyone's seeing those same 10 cities everywhere. So everyone's going to be jumping in. You're going to be outbid nonstop, or you might end up paying more for a property than you have to. The second way that we personally do it is we do our own analysis on every market. There's a lot of data out there that's free. So we go on some websites like citydata.com or even departmentofnumbers.com to find jobs data, population data. And just based on those metrics, we can determine whether a market has high growth potential for the appreciation and for the rents. And then we just target those markets. So that's step one, finding your target market. Step two is then building the team. So again, it's not just good enough to find a market and a deal. You need to have that ecosystem so that when you have a deal, you know who's going to manage your property. So finding a good agent and finding a good property manager are the two most important things, two most important team members that you need to start creating your system. And those are found either through referrals. If you have no referrals, then online forums like BiggerPockets is pretty good. If that doesn't exist either, then you can go on your own and find them through Yelp or Google and just make a lot of phone calls. And from those phone calls, you can find there's people who, when you talk to you, they really resonate on your same level. I would say those two main things: find your target market, find your team, and then you can start finding your deals.
So I think that's one of the key aspects right there is that the target market. So there are some certainly some great areas. People think Texas and Dallas. Okay, great. I'm going to start buying houses in Dallas. City data is not always right, because I think they're usually like 2 to 3, or sometimes 4 years behind the data. For the most part, you can get an idea as to if the deal makes sense or not. But I guess one thing that concerns me is if I were going to be investing in out-of-state deals, is how do you know that you're paying the right amount? And in the world of multifamily anyway, if I get a broker that calls me up out of the blue, out of Dallas, to try to pitch me a deal out of Dallas, I immediately think there's something wrong with that deal. Because why hasn't that broker talked to his inner circle first, right? Is he just trying to find someone from out of state to overpay for it? which is normal, right? That's usually what they end up doing. They're trying to find someone to overpay for it out of state. So how do you protect yourself from overpaying for stuff? I mean, is it just comps? Is it just looking at what Zillow says, or do you find that, or is it helpful to get access to paid data to figure that out? Hey, Augustino here, and I would love to connect directly with you. Text the word books to 844-428-1344 to receive weekly book recommendations from me.
So yeah, I think that is like going for paid data is great if you have the financial capability to do so, or if you even want to do so. I think, again, using city data isn't going to be like your guaranteed answer, but it's more like you can see the trends. Like, oh, it has been going up since this date, even though, yes, it is 2 or 3 years behind. So if you want like the latest, then yeah, go buy your new data set. So what I do is at that point, like, again, city data was more to determine like what markets qualify. Like there are some markets that are declining over the past 20 years. So you probably don't want to be in those markets. And then there are markets that are absolutely astounding. So then the next step was to find your team. And so your team can tell you, okay, this property here is in a decent neighborhood. Here's what rents could go for in this neighborhood. Like your property manager should know that information. In terms of like comps, that's what your real estate agent's for. Like if you don't know how to do it yourself, although I personally would recommend that you learn how to do comps. Look at the deal. I always get an inspection done as well, so you understand what it takes to get the job done. And then from there, hopefully you understand how to analyze deals as well. So when you analyze deals, you put in your calculator or you do whatever you do to count the numbers, and you look, you say, oh, does this deal make sense to me or not today? And again, if it's your very first time, I don't think you need to go for that super home run deal. Like just go for one that really makes sense, because you're going to learn so much from that buying process, from that very first deal, that it's okay to just take like just solid ones and not have to go for crazy home run deals for your very first deal.
You know, it's funny you said that. I spoke to a guy just recently. He, over his career, I think he bought 10,000 houses. He bought a lot of houses, right? And he mentioned that people are very impatient. Like they're expecting to buy a house for $50,000 and make a triple, right? Pull out 100K and sell it off. And it's some of the stuff I'm embellishing there, but they're expecting some sort of ridiculous return, right? But you're saying something that really resonates with me. He said the same thing. It's like not every deal needs to be 100K. You know what? Even if you make a couple $1,000 on the deal, but then you're cash flowing it for the next 10 years, that's okay too. That's perfectly fine. You don't need not every single one needs to be a home run, right? And that's great. No, that's very sound advice right there.
Yeah, I think a lot of people are also like very scared when it comes to their first deal, so it prevents them from even buying that first one. Like I host a meetup group, right? And I've had it for 3 years now. And there are some members that have been joining every single month since I've hosted it. And I keep asking for their progress. Like, oh, you've been joining us for a long time. Like, what's stopping you? And there's always something going on, And I think that fear is a very big component to it. But that fear has prevented them from buying into the market. And as you've seen for the past 2 years, even amongst this pandemic, the market has increased significantly. So they missed out on all those gains because they were too scared to just, dip their toe in the water in the first place.
Yeah. Now, something that you touched on a second ago was the team, right? And you mentioned a couple right there. You mentioned the broker or the real estate agent and the property manager. And I guess which one, if so in that case of this person who doesn't know what to do, what should they start with? They want to invest in a good market. They believe they found a good market. Great. Who should they start with? Who should that first phone call be targeting?
Yeah, great question. So I would say ultimately the property manager is more important than the real estate agent. However, I think for the very first call, I would personally prefer to talk to an agent. Because like when you're first deciding what market you want to invest in the first place, I think agents have a better pulse on the actual active market, whereas managers are just that stationary beast that will always be there for you for years and years to come. So yeah, I find an agent that really resonates with me, who knows my language. Someone doesn't talk too much and someone doesn't talk too little. Also, like you need to find an agent who is good at investments. So there are some agents that are great at their job, but they're really good at finding homes for homeowners. They'll talk to you about the great school district, about the beautiful yard in the front. As an investor, I don't really care about that stuff. We want to make sure the numbers work. So once you find that, you can also ask your agent, hey, do you know any great property managers who work well with you? So that way they can kind of become like a little team there. So yeah, I've had great synergy with my agents and my property managers who work together. Sometimes there are deals where the agent brings to me, but then already kind of talks to the property manager first and says, hey, is this a deal that you would manage? Because yeah, if they bring us a deal that the property manager wouldn't even touch, then that's something that we probably wouldn't even want because it's maybe too far out of our comfort zone. Yeah.
No, when it comes to the agent, no, you're absolutely right. I mean, I've had many agents spoken to and interviewed over the past several years since really looking at dabbling with some single family stuff. Many of these people were focused, just as you said, on families and trying to find a home for an individual as opposed to working with investors. That is absolutely key. And they will say whatever it takes to get your business, by the way. So you really have to figure that out sooner than later. Otherwise, you're going to be wasting a bunch of time on a potential agent that they're really not geared to handle investors. They're just not, and they don't know the first thing about handling it. But they'll say they will because they see that you're really motivated and want to buy 10 houses from them. Well, they'll say that they can service investors, but they're not. That's not where their heart is, right?
Yep, exactly.
Yeah. So when you're looking at property managers, then let's say, for instance, they refer you to the property manager, which I believe, it's absolutely key to find that person. What sort of things are you looking for in a PM? Because I mean, it's easy to find a PM, but there's plenty of them out there that are terrible, unfortunately. There's more bad ones than good ones. I probably shouldn't say that on a show, but it's true. I mean, there's a lot of them out there that are not so good. How do you figure that out? What sort of things are you looking for?
Again, it goes down to what kind of questions can you ask a property manager and what are the responses? Do those responses sound good to you? I ask them about what's their process for evictions. I ask them for the process of finding a tenant. I ask them about where they can and can't do property management services for. Some property managers will only do single family properties. Some of them are okay with doing multifamily. Some of them will do management in some neighborhoods and some won't. So I guess from there, you can kind of tell who you do want to work with and who you don't want to work with. Also, again, based on their communication patterns. So on the phone, if they're very courteous, they're patient with you, they want to talk to you, and they're friendly, I love that. Some of them are very rude, right? Mm-hmm. I've had people who are like, wow, I don't have time to talk to you, bye. And I'm like, wow, you just kind of shut off a client that could potentially give you a lot of business in the future. So again, it's all those factors combined. Again, from the past experiences, it's all been through referrals. My favorite property managers have all been referred by most likely my agents who have been there.
It's interesting with the PMs. What you said there is real in terms of an agent, or rather, you calling on an agent. You calling on a PM and the PM just hangs up on you or is very rude to you. I find that because of where we are in this real estate market, that happens a lot, right? And I think it's only because they're getting a barrage of phone calls. They're getting slammed. Same as the agents too. Everybody's getting slammed with these phone calls here, these out-of-state people calling, looking for houses, right? And they never know who's real or who's not. And if someone's making that first phone call, they're not really credible. It's kind of like, oh, great, I'm going to spend an hour on the phone talking to this guy about this market, and they can't buy anything. It doesn't sound like they're realistic. So how does someone get over that? How does someone that's just starting out anyway really position themselves as a potential real buyer when they're talking to these folks?
Yeah, so I think probably the best thing to do is write down your questions beforehand instead of just winging it. Because again, there are specific questions that you can ask that do sound like, okay, they know what they're talking about. They have these relevant questions. Let's go. But yeah, I mean, honestly, even for us, we had these questions. We are owners, but they were still relatively rude to us. I mean, this also kind of thinks, this relates back to what are we going to deal with in the future? These property managers are going to be in our lives for a decade or more. So if this is how they act on their first try, how are they going to be in the future if there's a problem that comes with our property? Are they just going to hang up on me or not pick up my phone call? We need someone that's communicative and friendly.
Yeah. One thing that I was telling some of our students and some of the meetups that we have is to have the website, at least have a website, even if it's a couple pages, so it looks somewhat credible, have a professional email address, right? It's a small thing that goes a long way. It positions you as a somewhat real player that you threw a couple $100 at a website and an email address. Okay. So maybe you've made some sort of commitment. I mean, it's certainly scary that even someone like you can make a phone call to some of these folks and they get hung up on. But I guess the way you look at it is, it's a very competitive market, and if you're going to be new to this, you're going to be competing with other folks just like you. You're going to have to really work extra hard to get those responses out of them, right?
Especially going with a new market, like expect to make 20 phone calls. That's what we usually do. And from there you can find maybe 2 people who are really great. And then from there you can decide which one you want to go with.
Yeah, that's right. So, and then as far as like the maintenance side is concerned, do you lean mainly on the PM, the property manager, to really handle that kind of stuff? Or are you hiring your own people to handle all that?
Yeah, so for most of our projects, it's 100% the property manager's responsibility. Mm-hmm. They have great connections with local contractors, and they'll be able to oversee the work. Now, that being said, we did recently do a BRRRR project where we bought a property that was completely run down, and we managed the general contractors directly instead of having our GC do it. Instead of having our property manager do it. And again, that's because this was such an intensive project. So again, normally for most like turns, most minor repairs, the property manager can do it. But if it's for major projects, major construction, we would go out and find our own GCs to do it.
Nice, good. Because that's often one of the big things is that once you go and cycle through a tenant, they leave after a year, maybe 2. Single families, typically the tenant stays longer for the most part than on a multifamily. But when they leave, you don't want to be saddled with worrying about the repairs and all that stuff. But again, what it comes down to at the very beginning is finding that good property manager you trust, because if they can easily steal from you, right? They can certainly add an extra box of flooring. They could add an extra bucket of paint. You would never know the difference. So really keeping track of those things and making sure your PM is on the same team. Same team is huge. It's very, very important. Very important.
Yep.
Yeah. I want to take a pause from today's show to share something that I've been encountering. As I speak to many investors, there's this concern, and the concern is centered around the inflation we've been experiencing and the devaluation of our currency. Now, we've seen some of the highest inflationary periods over the past 30 years. That's up over 8%. Economists actually believe that inflation is closer to 20%. Some say it's even more. Now, what does this mean for you? Well, it means that money that is sitting in your bank account or self-directed IRA that's not invested in physical assets that hedge against inflation are losing buying power. That means that every minute, every second, that dollar is becoming less valuable. You see this every day. You see this in the groceries you buy, the gasoline you buy, everyday items that you're buying on a daily basis are becoming more and more expensive, and you're using a less powerful dollar to buy these items. Meaning that dollar is losing value if it isn't put into a property that produces cash flow, just like real estate does. Now, our team here at Bulletproof Cash Flow has put together a series of weekly webinars that cover real estate investing like multifamily, net lease, and real estate development. Now, these are purely educational webinars. In these webinars, we talk about why real estate offers a powerful opportunity right now and why it makes sense to invest in these assets today. So, if you're interested in real estate or want to have the opportunity to get involved as a hedge against inflation yourself, I encourage you to go to bulletproofcashflow.com/webinars. That's bulletproofcashflow.com/webinars. Now you go there, these webinars are 45 minutes and they cover different topics every week. We go over the things you need to know to avoid some of the common pitfalls when it comes to investing while getting you prepared to invest your paper dollars into a real physical asset. Now, if you can't make the webinars, just go ahead and register and we will send you a recording that you can watch at any time. And by the way, these webinars are entirely free. There's no cost to you. This is just something that we do to educate our folks out there. So if you're enjoying this episode, please like and subscribe to Bulletproof Cash Flow. It helps the channel tremendously when you do. Now let's go ahead and get back to the show. What sort of systems are you using to help track all this? Is it really the PM that you rely on for that, or do you have your own internal systems and processes to help with that?
Yeah, realistically, the property managers do send out a statement every single month, and we do review it every month. Again, I do trust my property managers, so I don't question them on all the bills, but they do send the invoices as well.
Okay. All right. Good. That's good. I think as you get bigger, I imagine you're going to probably bring on some folks to help track all that stuff too, right? Because it's
already getting to be quite a pain. Yes. Yeah. So that's one thing too. So personally, I remember in 2018 or so, I was already kind of sick of buying these one or two properties. Yeah. I was thinking about going to multifamily side, and the big reason is there's so much. For every property you have a mortgage payment, you have an insurance payment, and property tax payment. Whereas for multifamily property, that's all in one giant building instead of having 30 different pieces of property or 30 different pieces of paper out there. But so yeah, multifamily helps you consolidate all that stuff. And I think in the future, once we do scale, maybe we will hire a bookkeeper. But yeah, so far we've been all doing it all by ourselves, besides our CPA who handles taxes.
It's a lot. It's a lot.
Yeah, it's a lot.
Yeah, I think that, and depending on the market, single family has a place. And there was a time a few years ago when I said there's no place for single family. Now I think there is a place for single family, just because the pricing for multifamily has gotten very crazy right now.
That's a good point. So in our market, we were trying to go for a 10 unit property.
Yeah.
But the per unit cost is more than a single family cost.
Yeah.
Isn't that nuts?
That's scary. I wouldn't do that. So it's I would never do that.
Yeah. So I'm why buy a multifamily asset, which is known to be riskier than just buy 10 single family properties?
Yeah.
So
yeah, a multifamily asset that's 10 units is way riskier. If you do 100 units, it's less risky than a 10 unit, right? Because you're working with bigger dollars. But it's I would say that that's exactly right. Why do a 10 unit for $120,000 each when you can go buy 10 single families for $80,000? It doesn't make any sense. It doesn't make any sense. Yep. And conceivably, and we can shift gears here, because you do hard money loans, you might be able to do them all yourself, right? So that's another key aspect as on the financing side. Sure, it takes a little bit longer at first, but if you're using hard money to get into the deal and fixing them up and pull out the equity, it works out. I think it works out better that way too, right?
Yeah, I mean, we have a lot of clients who do that strategy, right? They use a bridge loan to just quickly acquire the property, do whatever renovations they need, and then either sell the property or refinance. So happens all the time.
Yeah, well, let's talk a little bit about that. So now, how does that work? Is it? I'm assuming you're able to lend in just about all the states then?
We're licensed in 30 something states,
okay,
but most of the big ones.
Good. So how does that work then? Let's say someone finds they believe they found a nice asset. It might be in Florida, in what they believe might be a good market. Let's say Orlando or something like that. What's the next step?
Sure. So first step, they would call someone like myself. So I'm a loan officer, and you would tell us the details of the deal. So for every deal, we want to know the purchase price, your renovation cost, and the ARV, or the after repair value. We also do want to know information about yourself. What's your approximate credit score, and how much do you have in liquid funds? Basically, we want to see that, first of all, you are relatively credit worthy. You don't have a lot of histories of late payments or bankruptcies, and also that you have enough funds to completely do the deal. So it's not just you have enough for the down payment, but there's also closing costs when you buy the property, and there's renovation costs, and there's even 6 months of interest payments, because we don't want to just give you the deal and you have no more money to pay for the loan. So you need to have that kind of liquid funds saved somewhere. And then from there, we do our own analysis to make sure the deal actually makes sense and you can make a profit. You're not just assuming that you're going to sell this property for $2 million when all the comps around you are $500,000. Yeah. And so our escrow process does take some time, maybe 10 to 14 days if you're a newer investor. But still, it's a lot faster than getting a conventional loan, which usually takes 30 plus days.
Right. But I'm assuming it's helpful to, if you're really going to start pushing into this business, to really get pre-qualified, for lack of a better term, right? I mean, I'm assuming people have done that with you.
Absolutely. So, they usually call me and say, Sean, here are my statistics, right? Here's my approximate credit score, and here's how much I have in liquid funds, and here's my experience. How much have I done with real estate in the past? So from there, I can tell you what's our maximum LTV or loan to value, how much can we lend to you? And then from there, you can determine, all right, what's my maximum purchase price? So then you know, okay, going forward, I can only bid up to a certain amount for each deal. And I can even give you a letter so you can use that to submit with your offers.
Nice. So now, for those people that don't really know the difference, what's the difference between hard money and private money? Like, why would they consider using hard money over private money?
Yeah, so private money would be money that's from like a friend, a family member, maybe like a close associate. And because it's their own money, it's their private money, they have no like fixed terms. Like they can lend it to you for 1%, 0%, or even 100%, right? Maybe not 100% because of usury loss, but like they can lend to you whatever they want, and they have no set term limits. They have no set qualifications. You could have a 300 credit score if that even exists, and they can still lend you money if they trust you enough. Whereas for hard money like us, we're more on the institutional hard money side, where we have a quote unquote unlimited source of funds. Like one individual probably won't be able to tap into all the funds that we have. Whereas for a private money lender, they may only have between $100,000 and $1 million to lend out. Once that's out there, they're like, I'm done, no more. Whereas for us, we can keep lending and lending as long as you have the qualifications and you have the minimum for the liquidity that we want to see. Our rates are going to be lower, generally speaking. We're going to be in like the 8.5 range, maybe even lower if you have more experience. Private money tends to be a little bit higher, maybe 10% and 2 points. But again, it varies depending on the person. So those are the main differences. So we're going to be more institutionalized, so we do have regulations. We will go through an entire escrow process. We will do our due diligence and background check, but we have virtually unlimited funds, and we're going to be there for long term. Whereas a private money lender, they're very flexible, but they're limited in their funds.
And is there like a draw process as well? I'm guessing with a hard money loan too.
So if they want to get a construction loan, like let's say their rehab budget is for $50,000 and they don't have that right away, they can opt in for a construction loan. Now, construction loan does cost a little bit more to set up, and you usually do pay for that construction loan from day one, even though we don't give you those funds right away. And it's being distributed through a draw process, like you mentioned. And so for those listeners who don't know what that is, a draw process is when you go and you start doing your work, and you say, okay, phase one is I'm going to demolish the interior, and I'm going to put up new drywall. That's going to cost me X amount of money. And you break up your job into different phases like that. After you're done with each phase, you come back to us and you request a draw. So we would send an inspector over, just verify you did the work that you said you were going to do, check invoices, check receipts, and then we'll reimburse you based on what you spent so far through a draw. So you're going to just keep doing that through your project, and after all phases are done, you should have that $50,000 into your pocket again.
Nice. Good. Now, let's use this example again here. Someone's trying to buy this place, this house in Orlando, and maybe they're an out-of-state person doing this, and they're doing a rehab. What are some of the common mistakes that you see many people make as a lender? Like when you see something like this, you see someone doing some dumb things or whatever. What are some of the things that you've seen people do that gets them? So
I think a lot of things are lender specific, especially on the hard money side, because they all have their private funds. But I mean, for my company, I've seen some people, they don't understand that we do track where funds come from. Not necessarily like from your own bank account, but like at escrow. You're supposed to put in the earnest money deposit, or you're supposed to put in the down payment from your own funds or from the LLC that you control. And some people would just have their friends send in the down payment. And so when we see it, we're like, who is this person? Are they a second lien position? Are they like, who are they, right? We can't just have a random person putting monies into the account like that. So that's one dumb mistake that almost killed some deals. Luckily, we were able to work through that, but that's one big thing. Another big thing is people sometimes don't know how to analyze deals. Like they think that there's a good spread there, but they don't take into account closing costs or the rehab cost or holding costs for the hard money loan. So when you factor all those in, there's like no profit. And it's kind of like, you should know how to analyze deals. Like we're going to look at your deal to make sure it's like decent, but we're not responsible for your profit, right? Yeah. So that's another big issue.
Well, I think that too, if it's going to be your first deal, most people think they can flip a house in 2 months. And I think that things like that only happen if you're an experienced person that's been doing this for a while, and maybe you've done like already 20 houses and you have a team already geared up and ready to go, and you have the materials, you have everything you need, and you can just execute. Most people think they can just walk in and turn a house in 2 months. Or it's funny, I was just talking to somebody. They've owned this house for 6 months and still not done. And then he says, "Oh yeah, I think we're 2 weeks away though." I'm like, 2 weeks? What do you still have to do? "Oh, we have to do the entire bathroom." I go, "No, you don't. It's going to be more than 2 weeks, man."
Absolutely. I mean, I budget 5 months because even if it takes you 2 months to finish the renovations, you probably still have like a month or so to make it ready for the market.
Yeah.
And then you have to put it on the market, right? And it takes another 2 weeks or so to, get it sold or go pending. And then it takes another month or so for your buyer to go through their financing process to actually close on the deal. So there's a lot more than just doing the renovations.
Oh yeah.
I mean, going back to your other question too, some issues that come about is some people think that with hard money loans, it means you can get into a deal with zero money down, right? Like 0% down, 100% hard money. Like there are hard money lending companies out there, but they charge a lot, like 15% and 4 points or something like that. And they're very, very risky. Don't recommend it.
Yeah.
And same thing with like bad credit too. They assume that, oh, okay, like hard money loans, I can get in with like very, very bad credit. Again, they do have them out there, but you'll be in a lot of pain. So you have to make sure you have a very, very good deal to use those kind of loans.
That's right. Now I know some of those folks, and yes, very, very expensive. But you really have to have a lot of confidence in those deals if you're going to take something like that on. And I think to your point, if that's not for the faint of heart either. You really have to be able to take the hit if they take the house back and it doesn't wipe you out financially, So, it's for, I think that those types of loans, if you really have to do it, those are for sophisticated folks that know what they're doing. And if you really need to do those at all, but like in your case, it's still like, I think you mentioned like an 80% loan to value, somewhere in that range, depending on the risk level, of course. But it's a very different type of deal,
Yeah.
Right.
Like if you're willing to put in just 10 or 20% in the deal, suddenly your rates go down by half.
Yeah, that's right. So now, what sort of seasoning do you need to do on a deal like that? So let's say, for instance, again, this deal in Orlando, they take it, they fix it all up. So what sort of seasoning is required, and how do you get them out of that loan in 3 to 4 months?
So with our company, we actually have no prepayment penalty on our 12-month loans. So they can sell or refinance the next day if they wanted to. So there's no real seasoning period there. But basically, like once you're done with whatever you need to do, then you can implement your exit strategy, whether that's to sell the property or refinance it. And again, that part is not related to us, right? If they're refinancing it, then they're probably going with like some long-term lender, or they're just going to sell it on the market.
Interesting. Okay, so you guys aren't even doing any of the long-term stuff at all.
So we do. I guess I should have mentioned that too. Oh. We do have a DSCR product, which is a 30-year long-term loan. Again, those are best for investors who have a lot of rental properties already. My best clients have, let's say, 20 plus properties. And for the first 10, they use conventional financing at like 3 or 4%. But then afterwards, before, they would have to go through private money lendings, and they would get private money loans at 8%. So our loans at the time were like at 4% for 30-year fixed loans. They were like, yeah, sign me up all day. And we base those loans on the property's income, like how much rent does the property generate versus their expenses, like the mortgage payment, insurance, taxes, et cetera.
Interesting. Are you looking at an appraisal too? Like, do you have to still order an appraisal and all that?
Yeah. So unfortunately, the long-term product, it is completely separate from a regular hard-term loan because it's basically another conventional loan. Like the property needs to be rent ready from day one. Full appraisal is being done, so it takes 30 plus days to close on them. And unfortunately, with our current economic situation, rates have gone up quite a bit. So yeah, there's some big changes with the DSCR product lately.
Yeah. Because I mean, I guess there's been cases that I've heard. Actually, happened to a friend of mine that he had bought a loan with a hard money lender, and he went to go refinance with another lender, right? And this other lender, I don't know what they did with the appraisal, but the appraisal came in like super low. Like whoever the appraiser was, like totally screwed up the deal. Even I looked at it, I'm like, this is not right. This is incorrect. I knew this is incorrect. So a lot of it hinged on the appraisal. He ended up having to go back to a different lender, and he got it all squared away, but he still lost out all that time and money on the appraisal process, right? So, I mean, it's out of your control, obviously, as a lender. But I would imagine, though, that process of a regular 30-year regular refi still exists. And that means that all the processes have to go along with it in terms of the refi, right?
Yeah. I mean, personally, I don't like the appraisal process. Again, there's so much control on the appraiser's power. And even if you have comps to show it, sometimes they can just look at it and be like, all right, that's cute. And then not even use
throw
it,
it out, yeah.
right? Not take into consideration.
That's right.
Because it's an ego thing too. It's like, oh, you're challenging my appraisal. Like that's my profession. So, nothing you can do about it besides, going for another appraiser or another lender.
That's right. So, but I think that's a key aspect though, is that it sounds to me like you're able to handle everything from having them get in the deal to even getting out of the deal, which is great. Then go to the permanent market. And then now eventually say they have 10 or 15 of these things. Do you ever do like some sort of bigger refi to refinance like a package deal to see if you can pull out some equity when you cross collateralize stuff or what? Is that even a thing that you guys might do?
I mean, honestly, it would be the same process as a regular DSCR loan. It's just that we would pool the properties into one loan instead of having them done individually.
Yeah.
So it really depends on what they want to do. And so, we have cross-collateralized, we have pooled loans together as long as they're all in the same state.
Okay, same state. Got it. I mean, so given where things are at right now, you're obviously you guys are in the housing market. You guys see the deals, you see the valuations, you see the activity. What do you think the next, say 6 to 8 to 12 months looks like? I mean, do you see some sort of downturn coming or what? Housing is a really good indicator. So I'd love to get your views on that.
The good answer is who knows, right? Right now with our economic crisis, right now with the pandemic still going on, the war basically is messing up a lot of things as well. So, I guess from where I'm standing right now, it seems like the long-term markets aren't responding very favorably. Interest rates have gone up quite a bit. A lot of investors don't want this 30-year long-term. Well, sorry, when I say investors, I mean like loan buyers or whatever. They don't want the long-term loan as much because they're kind of scared of what the market's going to be. And so that means that the rates are going to be higher, right? You need to charge more for these long-term loans. So I've seen less long-term loans done this month than in the previous few months when we first rolled out this product. But the short-term side hasn't been affected. Like people love these short-term loans. As far as investors are concerned, my fix and flip investors have been doing very well. The past few months have been just amazing, even considering that it's winter. But where is it going to continue? I have no idea. Because as it is of today's recording, stock markets have been going down. Crypto has been going down over the past few months. Interest rates have been increasing. So maybe people are just still on that momentum of the buying frenzy. Maybe it'll cool off. Honestly, we have no idea. There's a lot of strange things happening here. So it's interesting to just be here and seeing how everything shakes out.
Yeah, good. Okay, interesting. So someone might be listening right now and they've been on the fence about investing in real estate. What sort of bulletproof advice would you offer that person?
Yeah, I would say right now, again, is a very interesting time. So be careful with your deals. That doesn't mean don't go into real estate. It doesn't mean stop what you're doing, but it just means be careful. Again, what I mean by this is I have some clients who get into their very first fix and flip deal and they're very successful at their first one. So they think it's very easy and they want to do 2 or 3 deals all at the same time and put all their money in. That's what you gotta be careful for. I would say because of the market and how it could shift in one direction or another, I wouldn't put all my liquid investments into one building or, all of them all at once, spread it out, keep some liquid reserves in case something happens. But again, if you want to get started, I would say educate yourself as much as you can. That's probably the best thing you can do at this moment. There are tons of free content online, like this podcast and my podcast, tons of free meetup groups as well. So go to meetup.com and find a great real estate meetup group near you to just start hanging out with other people, learning different strategies, and get started.
Of course, and even meeting other people too, and actually maybe even engaging with them on a partnership level, to include others in a deal with you. They'll keep you from making an experienced person, no less. That'll keep you from making a dumb mistake, right?
Yep.
That's probably the best money you could possibly spend.
Absolutely.
Excellent. All right, guys. Well, if you want to reach out to Shaunak, reach him via his website at everythingrei.com. Don't forget to check out his podcast as well. We love real estate. You can find that out as well. He's got many followers on TikTok as well. Check out his content. He's got some really good stuff. Hope you got some insight on how to get into the single family space and how to invest out of state. Looking forward to seeing you again soon. Take care.
You've been listening to the Bulletproof Cash Flow Show. We hope you've enjoyed the show. We know we had fun. Make sure to visit our Apple Podcast page and leave us a 5-star review. We hope you've gotten some useful and practical information from the show. For real estate coaching, events, and resources, hit up bulletproofcashflow.com. Till next time.
No information in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this show are limited to accredited or sophisticated investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice.